And I expect we've got 5 models that are cataloged right now, and then there are another 11 that are in the process of becoming cataloged, and then I expect there'll be more soon. So we'll see the size of that leadership council growing fairly rapidly. So if you want to submit a model, go check out pslmodels.org. You can read through the criteria, you can read through the submission guidelines, and then if your model is accepted into the catalog by meeting the criteria, the project will have the option to nominate someone to be represented on that council for making future decisions about future projects. So that's my only update, just a quick update on PSL governance. Aparna, come on up.
Great, thanks Matt and Anderson for hosting this. I just wanted to give a quick update on my paper with Cody Gallen on the distributional impacts of the TCJA. Are the slides up? Okay, sorry. Yeah, so Matt told me to keep this really short, so it's just a few slides. Basically, what our paper does is it looks at the Tax Cuts and Jobs Act and tries to model what the impacts on households are likely to be. As we all know, it's a super complicated tax bill with tons of provisions for individuals and companies. So we have a list of the provisions that we're actually able to model with Tax Calculator. Things like doubling of the standard deduction, elimination of personal and dependent exemption, child tax credit, cut in personal income tax rates, and then on the corporate side, the cut in the corporate rate to 21%, expensing, pass-through deductions, and so on. Some of these are easier to model than others. A direct cut in sort of the personal income tax rate for households is easier to model than the corporate. What happens when you have a corporate rate cut? What are the long-term impacts on businesses and households and wages and so on? So we've tried to do a lot of that in this paper. I would love your comments on this. Our model is located on GitHub. This is the link to it. It uses the U.S. Basically the IRS tax file for 2011, extrapolates it forward. We also match with the CPS to get some of the household level information that's not in the tax records. And this is basically what we're able to do. So we can look at the distributional, impacts at different income deciles, bottom decile, top deciles, and also break up the top into the top 1, the top, the next 5%, and so on, and look at, how many households actually are likely to experience a tax hike with the TCJA, how many are likely to face a tax cut. We do this for several years because, as we know, the provisions change over time or are completely done away with after a certain number of years. So initially, we do find, a lot of families, at least just looking at the individual provisions, do face a tax cut. In the longer run, as a lot of those provisions go away, more and more families face a tax hike. We also are able to do interesting demographic analysis, so looking at households with 3 or more children, because with the child tax credit expansion, we actually found that richer families tend to benefit more, and just on the individual side, that's likely due to things like the child tax credit and not really due to the cut in the personal income tax rates. Those are interesting sort of distributional impacts we have in there. We also model a dynamic corporate impact. So we say, well, if you have a rate cut, what's the impact in the long run on GDP growth? How do we translate that to households, down to individual households? What does the impact look like for people at different income deciles? And so we model both a static sort of corporate impact as well as a dynamic corporate impact. So I'm just going to end there and, happy to share a link to the paper and, look forward to questions from you over email. Thanks.
All right, thank you, Matt and Aparna. So now for the main event of the day, we have Ernie Tedeschi here to present a working paper that he recently worked on. So he is a policy economist and head of fiscal analysis at Evercore ISI, a macro advisory firm, and he's also a contributor to The Upshot in the New York Times and was previously a senior advisor and economist at the U.S. Department of the Treasury. His research interests include federal tax and transfer programs, monetary policy, and labor markets. So, Ernie, it's all yours.
Thanks, Anderson. Thank you to Matt for inviting me. Thank you for Peter for coordinating with me on this. And thank you to everyone involved in PSL writ large, particularly with Tax Calculator. As somebody from outside of this community, I can't emphasize to you how important and how high quality this set of research is and how useful it is to outsiders. You know, the work that you do is extremely important and has really brought tax policy a level of transparency at a critical time in our policy debate in a way where lots of different people can use it, whereas before it was really just people at a select number of think tanks or very narrow government agencies. So thank you very much for the work that you do. Just some groundskeeping first. So all of the code that I use here is available at this GitHub repository. And then the working paper, I'm not going to present the paper formally. I'm going to structure this presentation more of a how-to for integrating Tax Calculator with poverty analysis. But I will use my paper on the Earned Basic Income Tax Credit as an example toward the very end. You can look at that paper there at that link. So I'm going to divide this presentation into three parts. A very brief background on some of the CPS-based poverty measures that Census publishes. You don't need to be experts on poverty to understand sort of the model implications of poverty, but I do want to talk about some key issues with the way that we measure poverty, at least the official measures of poverty, that you should consider if you, as a tax calculator user, want to integrate poverty analysis. The second part of my presentation is going to be a very nitty-gritty how-to, just how do you actually take Tax Calculator and get it to talk with the current population survey. And then the third section will be very brief. I'm just going to draw on what I talked about in part 2 and then show you how they apply to an actual real-world tax calculator simulation on the Earned Basic Income Tax Credit. So let's talk about the way we measure poverty today. I'm going to talk about 3 measures of poverty that are derived from the current population survey. So there are other measures of poverty that we derive from other surveys, but I'm not going to talk about them, namely because I don't have enough time, and 2, because talking about the CPS is nice because there's already a level of integration of the CPS with Tax Calculator. So for example, if you're fans of the Meyer-Sullivan consumption-based poverty measure, which is based on the current expenditure survey, I won't be talking about that today. I think that's a whole other set of challenges for integrating with Tax Calculator. But anyway, we get our poverty data from the current population survey. You may know that that is a monthly survey from which we get statistics such as the unemployment rate, labor force participation rate. There was an annual supplement called the Annual Social and Economic Supplement. I'm going to call it the ASEC throughout this presentation. That's done every March, and they ask, it's a special supplement where they ask 75,000 CPS households retrospectively what their income was the prior year to a level of detail where they're able to aggregate it up to useful measures. So for example, in March of 2018, the ASEC would have asked these 75,000 households what their income was for 2017, and then that is where we get different measures of 2017 poverty. I'm going to talk more, I mentioned IPUMs there, I'm going to plug them a little bit later in the presentation, so I'm going to ignore them for now. So with the CPS, we can get 3 measures of poverty. There's the official poverty measure. There's a slightly modified version of the official poverty measure that uses disposable income. And then there is the supplemental poverty measure, which is much newer. Now, I'm going to start with the official poverty measure. There it is there. The official poverty measure was the brainchild of Molly Urshansky, who was an economist with the Social Security Administration in the 1960s. The thing you have to ask with any of these poverty measures, and there's a lot of complex calculations that go into them, a lot of issues, but I think you can boil down the differences to two different aspects, almost like a coin. One is, how do you measure income with this poverty approach? And second, what is the threshold for being or not being in poverty under this poverty approach? So the way that we officially measure poverty, the poverty threshold is set based on the cost of a minimum food diet in the 1960s multiplied by 3. That was Molly's sort of approach and contribution to the poverty debate. She noticed that surveys at the time in the 1960s, low-income households were spending about 1/3 of their income on food. So she therefore took what the government's estimate was of a minimum food diet for a family, and she multiplied it by 3. And that was her poverty threshold. Since then, it's generally been updated by the CPIU on an annual basis. So the official poverty threshold that we use today is essentially just the minimum food diet that the government thought we had back in the 1960s, multiplied by 3, updated for inflation. There's a lot more that goes into it. You know, that threshold is adjusted based on family size, but that's basically the way to think about the line between being in poverty and not being in poverty. On the income side, the way that we officially measure income for the purposes of determining whether you're in poverty, we use a measure that census calls money income. So to vastly oversimplify it, census looks at obviously any wages, any business income you get, any cash transfers that you get from the government. So Social Security does count toward your income, but things like food stamps do not count toward your income under the official poverty measure. The second thing is that it is a pre-tax measure. So taxes are neither withdrawn from your income for the purposes of official poverty, nor do you get the benefit of any tax credits from the federal government. So that's why I'm going to stop talking about it right now, because you as tax calculator users are probably not going to have much need or much use for a pre-tax measure of poverty, because any simulations you run in tax calculator are almost by definition not going to directly affect the official poverty measure. Now, I don't want to cop out of this too quickly, because we could make a modification to the official poverty measure. And so that's the second measure I'm going to talk about very briefly, which is official poverty using disposable income instead of money income as the measure. Everything you see here is exactly the same, except that to determine whether a family is above the poverty threshold, we're not going to use money income. We're going to use all post-transfer, whether it's in kind, like food stamps, or cash, like Social Security, and post-tax income, so it would have the benefit of the child tax credit, the EITC, other tax credits, as your income measure. The poverty threshold would stay exactly the same. That is, based on Molly Urshansky's original work. Now, there are some advantages and disadvantages to this approach for you as a tax calculator user. Number one, obviously, this measure is going to reflect changes in tax policy, so it will be useful to you as a researcher. The second thing is that the official poverty measure is an absolute poverty measure. That is that it does not vary with changes in the underlying distribution of income. Now, I'm not making a value judgment here. You can make cases for either an absolute or a relative poverty measure. However, from the standpoint of a modeler, from a standpoint of the question of how might we integrate poverty into tax calculator or another model, there's no question absolute measures are vastly easier to integrate into your assumptions, particularly one like the official poverty measure, which is just updated every year by CPIU. Tax calculator already has to make assumptions about CPIU going forward. I think you guys use CBO's projections under the economic baseline. So that's already there in tax calculator. It would be very straightforward to take the official poverty measure, change the way that we measure income, and then project it out in a tax calculator simulation. The disadvantage is that using disposable income this way is not an official census release. You can create it using a census like table creator tool that they have on their website, but it's not something that's published in the poverty data. So in terms of the people reading or consuming your work, it might be difficult to interpret or contextualize this, I don't want to say made-up measure. It is made up. It's made up for good reasons, for rigorous reasons, but they may not have the context to be able to interpret the policy impacts that you're conveying in your paper. So the third measure that I look at is the supplemental poverty measure. Now, the issues with the official poverty measure have been well known for a long time. So the National Academy of Sciences led a years-long review of the issues with official poverty, and they came up with this alternative poverty measure called the SPM that's been used for the last 8 or 9 years or so. And there are a lot of key differences between supplemental poverty and official poverty. So remember I told you that there are two sides of every poverty coin. You want to know how you measure income, and you want to know what the threshold is. So on the income side, it's a very different approach to income. The SPM looks at net resources. So it's similar in some ways to disposable income. They're looking at post-transfer, post-tax income. But SPM also does this little extra interesting thing, which is that they withhold, they take out some consumption as well, some what you might call unavoidable or necessary consumption like work expenses, medical expenses, and child support expenses. Not all consumption, and certainly not all consumption that we would consider necessities, but I think consumption items that census would consider sort of unavoidable. The other side of that coin, the way that we measure poverty threshold, we've ditched the entire idea of this minimum food budget-based poverty threshold, and now we're looking at the 33rd percentile of annual expenditures on food, clothing, shelter, and utilities, so-called FCSU. And then they increase that by 120%, or it's 120% of that, to add a little bit more of a margin on top of that. And then what the SPM does is it actually takes the 5-year average of that FCSU calculation to prevent any one-year noise from altering the thresholds. So automatically you can see that this is a very different way of looking at poverty. The advantages of using the supplemental poverty measure. So number one, again, it's going to reflect changes in tax policy because it is a post-tax, post-transfer approach to measuring poverty and income. And it's an official census release. So you running your simulation through tax calculator, presenting your results, people who understand poverty from either the left or the right through any context will be able to understand what the implications of your policy change are. The disadvantages, I don't want to get too hung up on this because I want to get to sort of the step-by-step of actually how to do this, but I will mention this because I think it's an important consideration when you're thinking about how the SPM poverty threshold might be integrated into tax calculator in the future, which is that so you saw that the poverty threshold for SPM is actually a distribution of expenditures. That means that the threshold that we use for poverty, if you project it out and you add a policy change on top of that, might actually be endogenous to the policy change that you're simulating. Whereas with official poverty, the only variable that official poverty relied on was inflation going forward, and we make the assumption that you make a policy change that's not going to have a material effect on CPIU inflation in the future. This, if you make a policy change, that might actually have an effect on what the 33rd percentile of expenditures are. Let me just spend 1 minute kind of digging into that, because to put this in different terms, it really goes to the question of whether the SPM is a relative or an absolute measure. And there's actually not been, I think, definitive or conclusive answers to this yet. Recall that, again, the threshold for SPM is the 33rd percentile of this FCSU subcategory of spending taken over a 5-year moving average. So on the one hand, you might look at this and you might say, aha, they're using a distribution of something. That is an aspect of a relative poverty measure. Therefore, we should treat this as a relative poverty measure. And that would be insightful. That there are aspects of a relative poverty measure in the SPM. But when we think about relative poverty measures, like, for example, if you look at OECD international comparisons of poverty, they might do something like 1/2 of median income across countries. We might think of that as a relative poverty measure. What we're doing with the SPM is not taking a distribution of income. we're taking a distribution of expenditures, and not even all expenditures at that. We're taking a distribution of a very narrow subset of expenditures. So that may not make it a relative poverty measure. Not to get too technical, but really what it boils down to is, do we think that the marginal propensity to consume for a lower income family into this FCSU category is 100% from any policy change that you might simulate? That is, do we expect that lower income families are going to spend dollar for dollar any tax change that you make into this FCSU category? I think it's very implausible that it's 100%. I think that we would expect that if you make a policy change, that low-income families are going to spend at least a portion of the marginal dollar on something other than this necessities category. They might save the money. They might spend the money on a different consumption category. It would seem to me that this is not a 100% marginal propensity to consume. On the other hand, it also seems plausible that the MPC for this is above zero, which means that while the SPM may not be a true relative poverty measure, it is an endogenous poverty measure. And to try to break this down like as clearly as possible, it means that if you were, say, making a change to the child tax credit in the future, or making a change to the earned income tax credit, and you were projecting out 5 years from now what the effect on SPM poverty would be, you would have to make an assumption, I think, about what the feedback effect from that policy change into expenditures on FCU would be. And that's a tough thing to assume because there isn't, the SPM is a relatively new poverty measure. There's not a robust literature behind those elasticities yet. So I think the bottom line for you, the tax calculator user, and I'll end this discussion here because I don't want to bore you with the technicalities of poverty, but I think if you're estimating a single year of poverty, and you're doing it at the beginning of your policy impact, you don't have to worry much about the endogeneity of the SPM poverty measure. Remember that SPM is a 5-year moving average, so a 1-year effect at the year of inception is not going to, I think, endogenously affect the SPM thresholds very much. So the techniques that I'm going to show you later on, which are like one-off, reintegrating with the SPS ASEC, I don't think you need to worry about endogeneity as an issue there. But as as the community is stepping back and thinking more about how might we integrate the SPM poverty measure into tax calculator going forward, when it comes to forecasts and projections and multi-year projections of poverty, I think that is something that needs to be thought about. At the very least, I think the user needs to be given the option of what the feedback effect between policy and the threshold would be. And then maybe if there's good literature on this in the future, tax calculator itself might want to make those assumptions as well. And then separately, beyond any of this discussion, right, the 33rd percentile of FCSU is not something, I don't think, that is projected by, say, CBO and its economic projections and its economic baseline, or not something that's made public. I'm not aware of any public projections of SPM poverty or the underlying thresholds, although they may be available from Census and BLS. So there's this whole separate discussion about how would you project this threshold going forward. Very simple with the official poverty measure, because it's just inflation. Here you need some sort of rule of thumb, maybe linking it to GDP or inflation. Unclear. So that's a whole separate question. Okay, enough about the technicalities of poverty. So hopefully that gives you enough of a background to understand where I'm coming from here. So for the second part, I actually want to go through the 4 steps that I went through to link tax calculator simulations with the CPS ASEC. So very basic 4-step process. You're going to create an extract. Step 2 is you're going to take the ASEC extract that you made, which is in individual and household space, and you're going to convert it into tax unit space in a way that is readable by tax calculator. Step 3 is very simple. You're going to run your policy. And step 4 is you're going to merge those results back into your ASEC extract, and you're going to aggregate the policy changes by whatever the appropriate poverty unit is. By the way, just to be clear, since we're dealing with microdata here, everything I do in this step-by-step is going to be based on the command line interface of tax calculator. So I know that some people prefer the API. I think we're kind of forced to use the command line interface in this context. But I will try to explain everything I'm doing and contextualize it. The other thing I'll say, too, is that since I had virtually all of these files already on my computer in Stata format, all of my code is in Stata. I know that Stata is not universally used by everyone, so I will try to explain in principle what I'm doing rather than rely on the code, so that if you're thinking in Python or you're thinking in R, you can understand at least what the mechanics are of what I'm doing in each of these steps. So when you go to my GitHub repository, which I pointed you to at the beginning of this presentation, you'll see 4 files there. And I name them in sequence of these steps that I'm talking about here. So tcpov1 is the first file. That's a Stata file. In this, that is really just taking the ASEC extract that you have. In this case, I'm taking the 2018 CPS ASEC that's giving us data on 2017. And it is creating it in a CSV format that will be readable by R in a second. Now, to get your CPS ASEC, I highly recommend using the University of Minnesota's IPOOM service. Totally free. The only thing they make you do is register and sign a statement saying you're not going to be evil, which no one in PSL is evil, so that's easy. And they have a very friendly user interface for selecting the variables that you need. Alternatively, the Census Department hosts raw fixed width files that you can download directly from their FTP server. I will note, as a word of caution, though, I'm going to refer to specific variable names in this presentation. Those variable names are IPOOM's variable names, not the raw census variable names. So you can use their data. Just know that the variable names are going to be different than the ones that I'm using in this presentation. If you want to use their data, the data is at that first link, and then NBER hosts library files that you can use to actually import the data into your statistical software of choice. So that's what the IPOOM's interface looks like. They have a lot of different data sets, so go to CPS, and then you can go down and you can select the 2018 ASEC and derive your variables from there. Those are the variables that you need. I'm not going to go through them, but if you refer to the presentation, that's sort of the roadmap that you need to be able to follow the code that I'm going to use throughout this presentation. You may also want to add other demographic variables too if you want to do demographic analysis of your tax changes. So, for example, you might put in race, you might put in education. Just be careful, because a lot of the IRS tables that tax calculator is calibrated off of often don't have those demographic variables to calibrate off of. So you just want to make sure that if you're trying to do tax calculator, distributional analysis by variables that are not officially released by IRS, that you're not using spurious variables that have not been calibrated by the underlying model. But as far as CPS poverty analysis goes, you should be able to safely use other demographic variables in the CPS as a way of understanding sort of what the distribution of poverty is. And then that last point is important. Make sure that when you download it from IPOOM's, you download it in CSV format, because that's what the code later on is going to use. All right, so that's step 1, fairly simple. Step 2 is a 2-substep process. So we have this ASEC extract that's in individual and household space. We need to get it into tax unit space in a way that's readable by tax calculator. So the 2 substeps are, we're going to take the ASEC and we're going to make it in tax unit space that is readable by TaxSim27. Then we're going to take that TaxSim27 file and we're going to make it readable by tax calculator. So for 2A, this is the tcpov2a file. I based a lot of my code on code that was previously written in R by Sam Portnow. That's the link to his original code. I made some minor edits in the way tax units are defined. I think he hard-coded that a tax unit had to be, that a married tax unit had to be a man and a woman. That obviously doesn't apply anymore, so I relieved that constraint. And then I also modified it so that it created 2 files that we're going to draw from later on in the process. One is this file called C17 TaxSim. That's the actual tax filer data that we're going to use in step 2B. And then the second is what I call IDs.csv. That's like a crosswalk. So that's going to link the tax calculator rec ID with 2 ASEC variables, serial and person number. In a given year, any record in the CPS ASEC is uniquely identified by the combination of serial and person number. So as long as you have just 1 year, you can use those two variables to uniquely identify every record in the CPS ASEC. We're going to need that at the very end of the process to merge everything back into the CPS. All right. Step 2B. For this step, what you're going to do, there's actually not code. I mean, I put placeholder code to like remind you of what the step is, but there's not actually anything relevant in that code. Because what you're doing here is you're going to take that C17 taxsim file and you're going to put it in the folder that is already provided to you by Tax Calculator, which is this validation folder for taxsim, and you're going to run this tax calc script and save it with that notation, or at least that's the notation that I use in a terminal in Mac OS. It might be slightly different for Windows. Basically, what this script is doing is it's taking this taxsim 27 base data and it's converting it to Tax Calculator data. And that's what we're going to use in step 3 in a second for running this simulation. The tax calc script takes whatever name you assign to the user data, and it just adds .csv to the end of it. So that's why I didn't give an extension to that file in the previous step, because I didn't want .csv to come out of it. So that's where we are at the end of step 2B. Step 3 is just you're running your policy. So if you've never used the command line interface for Tax Calculator before, that's essentially what it looks like. You want to run both a baseline and a reform simulation. So that's what it would look like if you have both of those there, and you want to make sure that the dump option is activated so that you get the full microdata as a result of the run. Now, I believe there's also an option in the command line interface where you can specify which variables you want in the dump. That's probably a lot more efficient. You super users will probably want to go through, figure out what we actually need later on, and then just limit the variables to that. That'll make it a lot quicker. But this is the basic idea, right? Is you're, pardon me, you're running Tax Calculator on this file that you made in the previous steps, and then you're running your reform file as well. Okay, and then finally, step 4 is just you're going to figure out what the change as a result of your policy was, and then you're going to merge it back into your original CPS extract. So I call this TCS POV4. We're back to Stata, so you have to be bilingual to follow the code that I posted. So I want to make sure that this is clear, because in practicing this for the 5th time this morning, I realized that this wasn't entirely clear. So the way that I do it in the code is that first, I take the Tax Calculator command line interface output. I merge everything together, and I figure out what the change in after-tax income is. I call that variable DATI in this case. So understand that that means that if there's a tax cut, DATI is positive. I think it just makes it makes aggregation later on a lot clearer. And then I merge in that IDs.csv crosswalk that we created earlier so that the rec IDs in that output are linked to the original serial and person numbers from the CPS ASEC. And then the only things that you need at that point are rec ID, person number, serial, and that DATI, that policy change variable for each record. And then that's what you're going to merge back into your original CPS ASEC extract on serial and person number there. In terms of aggregating the changes, these are the 4 key variables for the SPM poverty rate that you need to know. These 4 were listed in that grand list that I had earlier, but I want to focus on them specifically so that you understand what's going on. So in any policy measure, there are different definitions of family units. The distinctions are not important here, but understand that under the SPM, there's slightly different definition of family than under the official poverty measure. So the SPM family unit is a sequencer that tells you which family in that given year that record in the CPS belongs to. So you're going to aggregate these policy changes by that. The reason we want to aggregate by that is because there might be SPM family units with multiple tax units. If you have a middle-aged couple and then they have there's an older family living with them and they're all in the same family but they're separate tax units, you want to make sure that you aggregate them by the same tax unit so that you're aggregating the policy change by the relevant poverty unit. SPM total resources, that's the income measure under SPM for every record. So that's what we're going to add our policy change to. SPM threshold is the SPM poverty threshold for that particular SPM unit in the CPSA sec. And then SPM weight is just the weight that's used for weighting all of the different records in the CPS for the purposes of SPM poverty analysis. So I think this just basically describes what I just described. So you're going to sum up the change in ATI by family unit. Under the baseline with no policy changes, a family is in poverty if their total resources are below their SPM threshold. So you can code a variable that's a 1 or a 0 based on that condition. And then if they're in poverty under your policy change, you're just going to add the sum of the change in ATI by poverty units to those total resources and then see if they're still below that threshold. And then you weight all of the cells based on SPM weight right there. So let me get into an applied example using this paper that I wrote on the earned basic income tax credit. This will only take a couple minutes, and then I'll open it up to questions. So you probably all know the earned income tax credit, everybody's favorite trapezoid tax program, but just in case you don't, it's a wage subsidy that phases in with earnings and then after a certain point phases out with earnings. So when you start at $0 in earnings, you get $0 in credit. But then as you earn more along a certain range, you earn more and more dollars at the margin. How much more you earn and then what your maximum credit is depends on the number of children that you have. And then when that starts phasing out depends on the number of children you have and whether you're married or not. So for example, if you look back at 2018, joint married filer with 2 kids, they're getting no credit at no earnings, and then they get $40 additional credit for every $100 in additional earnings they make thereafter, up to the $5,716 maximum EITC. They reach that when they get to $14,290 in earnings. And then they maintain that credit. That credit is flat until the family reaches $24,250 in earnings, and then the EITC starts phasing out. But it phases out at a slower rate than it phases in. The family loses $21 and change for every $100 in earnings that they make beyond that $24,000 threshold. And then it's fully exhausted when they make a little bit above $50,000 in income. I think most people in this room are familiar with the mechanics of the EITC. Now, the issue that the Earned Basic Income Tax Credit is trying to address is that first point, that when you make no money, you get no credit. And so, you know, what if there were a way of sort of taking some of the concerns that have been present in the UBI debate and integrating them in a way with the Earned Income Tax Credit where people still have run room to make more credit as they earn more, but they still get a little bit even if they have no earnings. So that's where the Earned Basic Income Tax Credit comes in. You're modifying it so that zero income filers still receive some share of the earned income tax, of the maximum EITC. Under the baseline specification, that's 50%. So you go back to the 5,716. That would mean but a little over $2,800 would be the EBITC at $0 in income. But then the trade-off is that you reduce the phase-in rate of the EITC as a result of that. So you get half, in this case, of the maximum EITC at $0 in earnings, but then you get less additional EITC for every extra dollar in earnings that you make. As a result of that, the maximum credit, the thresholds involved, and the phase-out rates are all the same. So here's, okay, so this is a specific example with our same joint married filer with 2 kids. And then this is an actual graphic illustration of that. So the blue trapezoid is the way the ITC currently works, and then this orange dotted trapezoid is, or pentagon, is the way the EBITC would work. So you can see how in the phase-in range, it's making it a lower phase-in rate, but zero earners are still able to capture some of the maximum credit. In Tax Calculator, this is one line of policy change in the JSON file, which is this EITC basic fraction. Oh, and I meant to mention this too. So my basic strategy here, in terms of judging poverty impacts, is to take an actual historic CPS ASEC and look at what the impact of this policy would have been on that historical CPS year. The reason I did that is, the latest CPS that we have is 2018, so giving us data on 2017. That's recent enough where I think users can contextualize that. And then by taking an actual year, rather than me having to get my grubby hands into the data and make an assumption about how FCSU expenditures are going to evolve over the next 1 or 2 years, that allows me to avoid having to make those assumptions. So I think it's the best of both worlds. We don't have to make an assumption about FCSU, but we're still able to express poverty impacts in a way where it's consumable and understandable by the normal user. And we just have to preface it in this case as, had this policy been enacted in 2017, the equivalent poverty impact at that time would have been X, Y, or Z. So that's what I'm doing here. Here is the Stata code. So just in case you're not fluent in Stata, let me tell you what I'm doing. So that by sort SPM fam unit, that's aggregating by family unit. That's the way that we ensure that if there are multiple tax units in a single family unit, that all of the tax effects get aggregated by that family unit. SPM1, that's the baseline dummy variable for current poverty. SPM2, that's the dummy variable for SPM poverty under this particular policy reaction. And then out of SPM is just a way of me measuring the delta between the two of them there. So when you run that in Stata, so tab is just the Stata command for tabulation. IW is a way that we're using to weight it. So you'll notice that I'm using the weight there, the SPM weight there. And so when you look at the baseline, SPM1, you get 13.87% poverty rate and just under 44 million people in poverty. It matches what Census publishes as the official SPM poverty rate for 2017. And then if we go to SPM2, you'll remember that that's the other dummy variable there. We run it again using that weight, and then we're getting a number that's more like 13.5%. So almost a 40 basis point reduction in SPM poverty. And then by tabulating that out of SPM dummy variable that I made, we can see that in head terms, that's roughly 1.1 million people taken out of poverty by this poverty change in 2017. I mentioned before about adding demographic variables. So age is something that you have to have in there anyway to be able to create tax units. So you'll have that variable in your extract anyway. But if you want to figure out, in this case, the policy effects on child poverty, you can just set a condition for age less than 18 and do the exact same exercise and compare the two tables. So, I mean, really, it's just that was a very mechanical sort of how to do presentation. So I hope that was helpful, and if you have any questions, I'm happy to take them. But thank you very much for your attention.
Thank you, sir. Mark Tenney, Mathematical Finance. Last month, I talked to your colleague, Renee Ananano, about a project to get the government to host calibration data for bank and insurance risk models and to get derivative prices from dealers. Mm-hmm. And I talked to Brian Moore, the director of Bureau of Economic Analysis, about this. And so one of the issues is, does the government have the legal authority to just tell the dealers, give us your prices, every month for calibrating risk models? And so we have these 75,000 people, ordinary folks. And apparently the government just told them, give us your income information, or was it voluntary? Or my question is basically, does the government have the same authority to the derivative dealers? We want your prices. As to ordinary folks, we want your income.
Well, I am less useful than a lawyer. I'm an economist, so unfortunately I'm going to have to punt on that and say I'm not sure what the legal authority vis-a-vis risk dealers is. I'm fairly certain that when it comes to the CPS and the census, response is mandatory if you're selected for those surveys, although there is still one of the many issues with the CPS. One of the reasons why alternative poverty measures like the Meyer-Sullivan consumption-based model is because there have been response rate issues with the CPS over time, response rates coming down and down, particularly for certain questions. And so we increasingly want to verify that the data that we're getting through the CPS is matched by other surveys and by administrative data as well. So I'm sorry I can't answer your question about risk data, but that's where my pay grade ends. So
Okay.
Thank you. Kyle Pomerlow, Tax Foundation. Excellent, by the way. Question whether you plan to expand this. One area where I thought it would be interesting is evaluating the difference between the EITC and the Earned Basic Income Tax Credit is, of course, the effect on the labor force as well.
Right.
So
Right.
that million people, that's just the gross change on the transfer, but you're changing the effective marginal tax rate. Are you planning on doing that, or is that something that someone else will need to take your code and run with?
So what I did in this working paper was I used the tools in Tax Calculator to see how that change in effective marginal tax rate affected the revenue estimates from the EBITC. I did not take the next step and then look at how that affected labor market incentives or didn't. There's a discussion in the paper about that very fact and how it's just sort of in the sort of baseline classical model, you would expect there to be an impact on labor force as a result of the EBITC. There are some specific circumstances with the EITC and low-income people where maybe that's not the case or wouldn't be as high as we might expect if we were projecting those elasticities in other contexts. But I definitely agree that that's an important consideration and something where further research should go.
Mark Tenney again. Next month, I'm going to the IMF and World Bank spring meetings, and they have a lot of analytics sessions. And I just wondered if, obviously, the World Bank deals with the issue of poverty. And I just wondered, did you have any contacts with them, and is there any involvement of you or anyone related to this sort of projects to any of their research or work?
No, that's a good question. So no, this almost started out as a personal challenge. I mean, I was interested in the EBITC as a policy. I was also interested in the challenge of getting Tax Calculator and the CPS to talk with one another. So it was a nice way of getting those two things to work in tandem in the U.S. context. I think it would be, I think any sort of international tax comparison, particularly as it relates to poverty, would be really interesting. Just one of my personal bugaboos is that I think oftentimes the discussions of poverty in the international context, in often cases, ignore tax, often because the data is of different quality in other countries than it is from here, where the data is generally high quality, and often because researchers have just completely forgotten about it. Although that's increasingly becoming more and more known, I think, where researchers understand that tax expenditures are one of the prime ways that advanced countries, and the United States in particular, tackles the poverty problem. So anyway, that's a long way of saying, no, I haven't talked with them, but I think it would be a really interesting issue to kind of toss up to the international context as well.
Okay, good.
Hi, Daniel Bunn, also with Tax Foundation. Very nice presentation. What would you think of kind of reversing what you did instead of looking at an additional policy, looking at a policy change of potentially removing EITC to see what the effect of EITC on poverty is using Tax Calculator in that method? Obviously, there's a lot of research on what EITC does in reducing poverty, but I wanted to get your thoughts on kind of using your methodology to estimate that, or if you even tried that.
So no, I haven't tried that. So I think in principle, from a static perspective, it should be very possible to do it exactly the same way that I've laid out. But I think that the issues that Kyle raised about sort of microdynamic effects, right, on labor force, particularly when you're making a major policy change like that, I think would be important considerations at that point. And I think the Tax Foundation has some way of accounting for that. So, but I think I would expect there to be a nice, robust discussion around those issues, right, if you were simulating those things.
When you actually run these things, do you get an analytic solution, or do you run multiple cases to solve these problems? And second, do you parameterize things like the various inflation rates and risks are not really scalars; they're non-parametric statistics.
Right.
And can you get a more and I guess you're looking for a more micro solution than the Department of than the various government statistics. So you can test different policies. Now, how do you present the results when you've finished the simulation, and what kind of results can you get out of this?
That's a very good question. So on the one hand, the results come from tax calculator. So there was a single solution that when you make a set of assumptions, there's a single solution that comes out of that, and then that's reintegrated in this methodology to the CPS. Now the CPS has a margin of error, and you can calculate that. I haven't given thought to how you would calculate that margin of error if you've then made a policy change to the underlying CPS. That seems to introduce a whole other bit of uncertainty to just normal statistical or survey-based margin of error. So I think that's important. I think you raised an important issue there. And then I absolutely agree that when you're making, if we got to the point where tax calculator were making forecasts about things like inflation or FCSU expenditures, you're absolutely right that there is a range of uncertainty around those estimates, and conveying uncertainty to policymakers. I mean, it's the age-old challenge that economists have faced in DC. It's tough to convey uncertainty to policymakers. They want a single number, and we of course know, running the models, that that's not the case. That there are a bunch of different outcomes. So. That would be a challenge here as well. No, so I think I'm addressing a different challenge, which is how do we get the point estimate? And then I think one of the next challenges is what's the uncertainty around that point estimate? And that depends on all the different variables that I mentioned before.
Do we think that UBI is typically going to be structured as a tax credit program? And secondly, I mean, using the IRS data, how much are you able to actually get people who don't even file taxes? Right. And then, you're trying to say, okay, these people are supposed to get money as well. Isn't it more natural to sort of say, okay, this is the cost of a UBI policy, and what if we use that to replace TANF or use that to replace, food stamps, rather than use that to replace the EITC or sort of lower the benefits of the EITC?
Yeah, so I think that's a very good question. So obviously the way that you deliver any UBI or zero income tax credit like this, negative income tax, is going to be key in terms of what take-up is and how effective it is at the end of the day. There are other considerations too, which is that as of right now, if we were doing this through the tax code, poor families would get it once a year in April. Right, which is, if we're trying to alleviate liquidity concerns for families, we're going to want something that's done at least quarterly, if not monthly, or even more frequent than that. That's what the advanced EITC program tried to address, and that was ultimately unsuccessful for a lot of different reasons. So I agree with it. That's a very important consideration. In terms of, whether it would be, so I think that those are the main effectiveness concerns that I would have. Did I answer both sides of your question?
Yeah, I mean, did you try to substitute away from TANF and food stamps to UBI? Oh. Like, is that a more natural policy to model than the
Yeah,
EITC.
I think that's a very plausible policy that you might imagine, sort of more like the British approach, where you're consolidating a lot of different programs into a single credit, and you're substituting away from existing programs, both as a way to pay for it and as a way to simplify the existing structure. So that's definitely something that could be modeled this way.
To follow up on your question, is this a way to replace quantitative easing? When we're at the zero lower bound, could we push these numbers up, both numbers, the peak number as well as the zero number? And is it cheaper than quantitative easing as a policy?
So I don't know that it's cheaper necessarily. It depends on how this would be financed. So you could imagine the federal government making this policy change and then the Fed buying the resulting bonds that were issued as a result of the increase in the deficit to finance it, because that would be a form of quantitative easing, although strictly quantitative easing was also just as, it was a lot about the duration, the duration weight of the existing Treasury supply as it was what, the aggregate amount that Treasury owns. But you could imagine it that way, and you could also imagine that I didn't look at this, but there might be a case one might make the case that this is more targeted at low-income families than traditional quantitative easing, because you're using quantitative easing to finance a program that is targeted at not just low-income families, but the very lowest income families. I haven't thought a lot about that argument. It seems plausible on its face, but I think a lot more research would have to be done on it.
Hi, my name is Brikisha Sams, and I'm with the Pew Charitable Trust. And my question is related to, at the end of the presentation, you talked about how there are age variables. So I was wondering if you incorporated that into your EITC for childless workers. Because I know to receive the credit, you have to be between 25 and 65. So I was wondering if you changed that age limit in your policy.
So I'm sorry, which variables were you talking about?
The age variable.
Oh, the age variable, when I was aggregating by age.
Yes.
So the parameters of the EITC are already set in tax calculator. So that's actually a very important point, is that when I'm with that one line of code that I in the JSON file that I did to quote unquote create an EITC, that assumes that all the other parameters of the EITC stay in place, including what you mentioned, which is that it's only you have to be below 64. And I think right now, don't you have to be 25 and older to be eligible? You're right. So both of those age parameters are still in place for the EITC. Now in tax calculator, in addition to that, that basic frac line that I did to create an EITC, you could add. I think there's another variable that lets you change the floor of the age for being eligible for the EITC. You can make that change as well. I think that you can assign the EITC based on individuals rather than tax units in tax calculator. You could make that change as well, and then those would all stack with one another, and you would get a final result. But I think so. You make a very important point, and I'm glad that you asked that question. As of right now, the underlying parameters of the EBITC are exactly the same as the EITC, other than that, that 50% to zero earners and that reduction in the phase-in rate. In terms of then tabulating here by age, as long as, given those assumptions that I just told you about, this tabulation should be correct, right? Because it's just, you've made a policy change based on those assumptions. Those kids are in family units headed by adults who who are, if they're over 25 and under 64, they're going to receive the EBITC, and then that's the ultimate effect for those kids as a result of tabulating the policy change. So, any other questions? Great. Fantastic audience. Thank you very much for having me, and I hope this was helpful for all of your tax modeling needs. So.
All right, thank you, Ernie, for your great presentation, and thanks to all of y'all for coming out. If you want to hang out and sort of mingle for a bit, we have some snacks in the back for you to grab. Before you leave, make sure to sign up for our email newsletter if you haven't already so that you can be updated as we have more of these events. And we look forward to having you all back next month. Thanks.